So we're moving into middle of March, end of March, 22nd of March, and we've got a lot going on. We're near some blue sky highs, which means we haven't been up here in a while, and it's kind of a grindy underlying strength. If you've been in the trading room, you know that today was down near the lows. If you're watching this in the future, we had the Brussels terrorist attacks come out overnight in our markets. We didn't break that much. We did break about 10 points and then rally back and then try to break and make new lows and then rally back. And now here we are kind of grinding north. We came off and slipped a few handles, but it seems like there's some corporate buyback. We've heard deadlines to be able to do that. That's creating this invisible bid in the market that's keeping us buoyant in markets and geopolitical events that otherwise would keep pressure on us. So it's even more important to know your step one. And we went over this last week, and more or less my step one, what gets me to firm up in my seat, and that's what I want to continue to walk us down. What is your step one? To mechanicalize the process without over-mechanicalizing it, but to create some rules so you guys know when you're trading within your method and when you're not. So you have more objective and accurate self-reflection and review as to how you're actually trading. So we'll call this step one, part two. George is going to run through what firms and gets him to pick up his gun in this ready, aim, fire progression. Most people fire before they aim. Heck, they fire before they're ready, and they don't even know it. That's dangerous. When you're walking down a path that there's a cliff at the end of it, and you don't know that you're on that path till you're at the bottom of that cliff, you got no chance. You got to know when you're trading poor to have a chance to fix it as to what you're doing. The most dangerous thing is to blame something that has nothing to do with what you're doing. It's not going to fix it. That's what this step one progression and topic has been about. So we've got some volunteers also from last week. George's will be a little longer today than some of the other sessions I'd like to do. Who were the guys again last week that are willing in the future, next week and the following weeks, to share in a very 5 or 10 minute presentation? They don't have to prepare slides. Just share in an interview fashion with me their step one. Who was it that volunteered last week? Could you give me a reminder while I switch things over to George? And so what will happen is those guys, there was a half a dozen of them. You don't have to do it. I'm not going to make anyone do it. Don't feel uncomfortable if you can't do it, but you should pretend like you're going to do it. You have to pretend like you have to present your trading style that I'm sure fits within our edge methodology, but you have to present your edge style to someone who you want them to back you, for instance. I didn't have to do that when I started at a prop firm. However, I had to prove that I knew what I was doing in an interview, or I had some background. You guys have to have an explanation put together so that you know that if you could explain it, boy, you have a better chance of recognizing it when you're in an emotional state. That's what the whole point of it is. And there'll be a lot of overlap, and that's good. It's all part of it. But we're trying to create as much objectivity in a very subjective environment. So we've got a few guys, good. Peter, Jeremy, Tom. There was a few other guys. Maybe they're not here or here yet. So let me kick things over to George and share his screens. Give me a moment to do that. All right, George, you should see it prompt to show what you got.
Do you guys see screen?
Yes. Now,
right.
Just walk us through. Nothing's going on, let's say, and something, well, I don't want to structure it for you. Just essentially what gets you to pick up your gun or sit up in your chair and anticipate and what that looks like. And we'll kind of take it from there. So you can handle the pen and everything. You know how to do that, right?
Yeah. I mean, if I figure out a line in the sand, and I have a bias already, Depending on the circumstance, I will, I might like test the market small, and then if I get confirmation, try to get in bigger.
But what's going to give you a bias, though? What's the first thing that might give you a bias, for example?
Well, there's a number of factors, really.
All right. Well, let's say you're bearish.
Mm-hmm.
What's your step one to sit up in your chair to execute a bearish bias? Walk us through on a chart what you're looking for to create your line in the sand, and then your risk and things like that.
Well, I've been using this bar chart. So step one would be to, see if we're in a consolidation or not, or if we're moving directionally. Like I recognize this as a consolidation, and then, kind of in the morning I had a bearish bias, and you want to try to attempt, if this is a consolidation before we break down significantly, I look to try to sell the top of it, with some potential confirmation from I've been looking at the 10-year note, maybe some strength in the 10-year note. This is a 10-year note. And then, try to manage the position accordingly. Kind of the idea for me really is the market's either efficient, it'll be too hard for me to write it out, or inefficient. So in this consolidation, it was efficient. It attempted to break out to the downside and get inefficient, but what happened is it got rejected and sliced through it much faster than it took to make it. So that's kind of my theory at all times, is I'm very consolidated to not consolidated oriented. And you can see it in this chart, the 6 PNF and, the footprint. And then I keep this, 30-minute chart just to look at, what's been happening in the bigger picture. And, the help of the bonds or the Euro stocks, something like that, depending on where they are compared to their most recent high on a 30-minute chart or whatever, will help me get in. And then once I'm in, the market will tell me if it's good or not. Certain things happen when, you're short, like the price goes down and continues to go down till it stops going down. And if you're long, it's the same thing. It either continues to go up or stops going up, and then that'll kind of tell you what's going on. And then I use the split profile. This is a night session, this is a day session, for magnets. And then I try to figure out how good of a job it's doing getting to those magnets.
I like this because here I wrote down what you were saying. You're looking to see if a market's directional and consolidating and where they're at. If you have a bearish bias, you're looking to sell near the top of recognized consolidation.
Yes.
You're also looking at a helper, in this case, the 10-year note. You're also
10-year note, the European stocks, the crude oil, all of it, NASDAQ.
Right. So, okay, good. So more than one, but helpers. You're looking at magnets below or above and how well. That's part of how you maybe create your bias, how well it's getting down to lower magnets or upper magnets. You're also looking at, is it easier to go down than up? Because if it's easier to go up than down, then that bias might get changed or affected. And therefore, that's a part of, like, when you're in a trade, is it easier to go up or down? Helps to
Yes.
confirm your bias other than just your
Hey, you know, I mean, where you got in and what you're risking, you know, that's going to tell you if your bias and your trade location is good or not. I mean,
where are you ultimately right now no longer bearish or go from bearish to neutral based on
right now?
Yeah.
You know what? I'll tell you what, and I described this in the team room.
It's one of your girlfriends.
No. I described this in the team room. This buying right here kind of put a stop to our downside. I mean, we were well on our way down here, and then they came in and zapped it and kind of put a stop to the downside, you know. And then with the combination of, you know, the Euro stocks, you know, that was down there, and I think the Euro stocks got stronger first. You know, it definitely made me concerned short. You know, and I was short from much higher. I wasn't quite as confident. Well, I mean, not much higher, but much higher.
Where is it? Where would you say now are shorts in somewhat a little bit of trouble if it breaches what price?
Right now, you know, position shorts on a day right here.
Yeah, that's exactly what I was looking at too.
I mean, I could show you that in this chart, in every chart, why it would be that.
Yeah,
you know.
I was just seeing if we're on the same page for a lot of the same reasons as to where, if you were bearish, where you want to stop being bearish, or your risk has to be managed.
To that line in the sand.
Right.
Yeah. I mean, you can see it on this chart. You know, it's right there. It's this consolidation.
Yes.
Then you had this one. And then you were well on your way. You got rejected, but what the heck are we doing back here? I mean, this could end up being resistance. If if you're a bear, it's probably worth a shot because maybe you have a quick transit. But no, up above here, you potentially are in trouble, and you don't want to fall in love with it. Above 41.5.
But let's say the market, it's you just turn your screens on, okay?
Mm-hmm.
You're not looking to put on a trade as soon as you turn your screens on.
Sometimes. No, I'm kidding.
Well, if it comes right into your progression, yeah. But what is, like? Let's say I'm already giving you a bias and said, George, the market's bearish. Even if it ends up being bullish, doesn't matter. All you are able to do is trade from the short side. So would it be fair to say that your step one is what? Identify consolidation.
Yes.
Okay.
And it's like a progression. You know, I'll take a look at this, and I'll be like, you know, where would it take the break to really get it bearish? Well, I mean, really in this, you'd have to break like 34, 35.
Okay, good.
Because right now we're doing a consolidation up here, right?
Yeah.
And if you get above this recent high, you might get extremely inefficient. And if you get below this one, maybe you're going to test here, 34, 35. I'll also look at this, which is kind of the same, but you know, you can see consolidations very nicely in this, you know, station to station. I mean, you know, you could follow along, you know, where the fights have taken place. And then after I have kind of a sense of some price levels, you know, I'll also look at the market profile if there's any magnets like single prints, naked, POCs, anything like that. then, I'll pick some stuff that happens quite often and see how good of a job it does doing that.
Here, let me ask you this. Do you have the gun in your hand right now, or is it on the ground?
Right now it's on the ground because I'm doing this. But, if anything
What would
right
get
now,
it? Let's say you're not doing this. Let's say what would get you to pick it up? What would have to happen to get you to pick it up?
kind of what happened, uh, what happened is, right now, I don't know, maybe, let me see. I'm starting to get a little more and more bullish, because they kind of put a stop to it here. And then I'm like, well, if we're going to consolidate, in this price level, maybe they test here again, 39, and then you might be able to get in long. That would be it for me right now, is a retest of lower prices to potentially try to get in long. Or, a quick move higher and don't violate, 41.5 and really bid it above it. Maybe I'll take a short, depending on what else is going on. If I see maybe the 10-year uptick, I might, throw in a sell, just to see if anything happens. And, sometimes I'll start small just to test, to see what's going on. And then, once I'm in the market, it seems like I get the best information and I'm the most alert, and then I know how to react.
And do you add?
Sometimes, yeah.
But how? When there's a difference between adding and averaging, do you have the plan before you get in? To okay, I'm planning on sell. Okay, so, but you're not adding just because it didn't work.
No.
Was that a past problem of yours years and years ago?
Yeah, it got me into trouble before.
And but you've fixed it, right? You've controlled it. It's more managed.
Yeah. It's not. It wasn't like, it was more of an emotional thing than anything else. You know what I mean? You just get disgruntled when something's not working, so you try to fix it. And, sometimes that's the path that leads you to really, really making something that didn't have to be so ugly turn really ugly, So,
there's nothing to get you to pick up your gun, though, right now, is there?
It seems to be kind of holding that 41.5 level, right now.
So if you're short, you're wrong about 41.5?
Well, yeah, because if you're short, generally you want the market to go down,
But that's your risk. But when it doesn't, your risk is?
Well, I might scratch it. But I'll definitely be out if it goes above 41.5.
Good, that's what I was getting at. And that's the overall point, is your initial risk doesn't have to be your average risk. So he could have risked 41.5 and say, if I'm short here, I'm going to puke it above 41.5, but that doesn't mean that I won't maybe scratch it because it's just not moving.
Right.
10 years is something to get me to heck out before. I could anticipate that my stop is probably going to be taken out, so I'm just...
Well, unless there's a blatant, let's say I'm short right now and there's a blatant 4 or 5 tick up move in the 10-year, and for whatever reason the S&P starts flirting higher than my price, I might hang on, okay, for a little bit just to see if that's a part of a shakeout. I might even sell more, okay. But ultimately, if everything is the way that it is, and I'm short and it's not doing anything, well, even if I'm being a grouch about it, I'll only give it the 41.5, 41 quarter, or even 41.75. But, in a short position from here, I might be in small, just a 2 lot. And then if I get onto something, well, maybe I'll add to it on the way down too, You know, it all depends. It's all situational, you know. But the key is, you know, I'm not getting, I will not allow myself to get stuck, you know. I'm always a pessimist about the trade before I'm an optimist. You know, even if it's one tick against me, I'm very pessimistic about it, you know, because if it's good, you know, it really should be doing what you thought it was doing. And, you know, that's why commission costs can get accumulated. And for me, it really makes sense to be a member.
No, that's good. That's
I mean, I'm kind of like a fisherman, you know. Sometimes you gotta sacrifice some worms before you catch a fish.
yeah.
You
Well,
know,
yeah.
sometimes you reel it back in and the worm is still on it, right? So that's a scratch, and you know, it didn't even cost you a worm. Maybe like a third of the worm broke off or something, so that could be the commission cost. And then sometimes you throw it in and then you catch the fish, and you know, that really works out. And then sometimes you throw it in and the worm goes flying off the hook, but as long as you got more worms, you can keep fishing. You know, you don't want to use all your worms.
You're managing your worms. Hey, this is something that gets me to firm up in my seat and yours as well. You see how it's flickering as it's getting to this 41.5? I would have assumed that it's bullish above 40.75. Draw the line on your 6 P&F where that comes in. You're already going to see it, the middle of that fight. Draw a line in the middle of that fight. There you go. Yeah. And once it started getting above there, it went 4 ticks pretty easy. That would have got me to firm in my seat if I was looking to buy it. Or if I'm looking to do something, let me put it that way. If I'm looking to do something, I'm going to firm up in my seat on the approach to that purple line George just drew and try to buy it through there, especially if an ancillary is down ticking like the bonds. But if I was looking to do something, that would have got me to firm up in my seat to take a shot. And you guys know that the bullish above, bearish below moments, not just because it would have worked.
This is the European close, huh? Coming in, buying the
Good
Euro
point.
stock.
Yeah. So you got the helper, you got the ice, you got the cliff.
Yeah, you got the Euro currency leaking lower. 10-year hasn't really broke down yet much. I mean, that might be that might actually, you know, this move higher might make me maybe sell a few 10-years, see if I can get a tick out of it, you know. Because sometimes that one takes a sec to go, you know.
How much does being a member save you, roughly?
Well, your exchange fees without being a member is $2.34. And if you're a member and you're a leasee, it ends up being 94 cents. And then you actually get even less if you do so much volume. So it saves you $1.40 per turn. For me, what is anywhere from $2,000 to $5,000 a month. So it's significant.
Here's a good question, and I would know the answer to this, but I don't want to answer for you. Nick says he's not questioning or disagreeing with what you're saying. He just wants to understand. If a trend helps create your bias, and the trend is up since the open, why would you look for a short?
Why would I look for a short?
If the trend is up.
Yeah, just because that's my bias, but I know what to do with it. You know, I won't fall in love with it. You know,
right, and the answer is because trends fail. Like,
yeah, I mean, yeah, they do.
You can't just say we're up and this is the thing. You could say there's been some direction, but then direction and consolidation, is it going to go continue up, or is it going to fall out of the consolidation and go down? So that's where the whole thing, the trend is your friend, because they don't always just continue to follow through and up. So you know the trend, and this was my epiphany moment when I traded. I think it was part of my moment of clarity is if the market rallied, it's already rallied. So yeah, it might continue to rally, but if all those people who bought it that got it to rally, because a lot of people had to buy it and want to buy it and push it up, why would it retrace? And it's because the people who bought it have to sell it. And I just remember looking at a chart and saying, that's the reason why it went up and the reason why it would go down, and that creates the favorable moments. So I don't think it would be fair to say, correct me if I'm wrong, George, but I don't think it's fair to say because you've identified a trend that that's always going to be your bias. Like it's an uptrend, right, so I'm going to be bullish until it's a downtrend. You can't think that way.
I mean, I could have a predetermined bias. Like literally, I could flip a coin and then I'll look for the right stuff to be able to execute whatever the coin told me. I'm looking to identify consolidation. If I'm a bull, I want to try to buy the bottom of the consolidation. If I'm a bear, I want to try to sell the top of it.
Yeah, and that's why I tell people that this business is taught the wrong way. It's taught how to create a bias first. That should be the last thing that's taught, because you'll learn that the easiest and by default if you learn the other stuff first. The other stuff is the execution of a bias. Before you even get it, you're going to learn how to execute it.
I mean,
the bias could get you to fall in love and really screw up your execution, because you never learned how to execute. All you learned was to create a bullish or bearish bias. You've never learned to execute it. This is most people. And a bias is always going to interfere with your ability to make decisions because you're already sold. You're already sold on it going up. It's going to impair your decisions of playing it from the other side or being open-minded. So that's why you've got to learn this bit. Why do you think the first exercises essentially in this whole course when the coaching session started was how to quote the market? Go ahead, George. What are you going to add?
Well, I was just going to say, I mean, people in general are fairly optimistic, but that's the wrong thing to do. You got to be a pessimist with every single trade and be upset with it and don't want to be in it when it's going against you because it's not doing what it's supposed to do.
Man, that's perfect. I love that. And I said that to someone in a different way. I said, I'm going to assume every trade I take is a loser. So I'm not surprised if it is. And they said, great question, what they came back with. Well, how could you get confident if everything you're going to do is assumed a loser? And I go, that's where the skill is. That's where the money is. How could you get confident when you're assuming you're going to be wrong? You do. You can. Because you're not always wrong. That's how you get confident. Exactly.
And, the price itself and, how the market starts trading confirms it. Yeah, with every trade when I get in, I'm somewhat optimistic, but on my execution level, I'm extremely pessimistic. It turns out today, if I were more bullish than bearish, I would have done great, but I still managed to eke out something being bearish.
Yeah.
Just because, executing properly.
Yeah.
Got to be on top of it and don't get emotional. And the way you won't get emotional is because you're a pessimist at first. I mean, there's nothing you can do about something and they sell it and the price goes up. The only thing you can do is, minimize, it's like you're watching a team get blown out and then you double down on it because you think they'll come back and win.
Yeah. And you don't don't have to, meaning you're not allowed to bet on the game. Well, you are at halftime in Vegas, but for all intents and purposes, and then the odds change to bake in what happened in the first half. But when you bet on a game or a boxing match, that's a good way to put it. Someone used that Brock used that as an example a couple weeks ago. When you bet on a boxing match, you can't change your bet after the first or second round after you've seen how the fighter has done. But what if you bet on a fighter and you put money on it and he looked absolutely horrible in the first round, and then you bet more on him? And the second round he looks terrible, and you keep betting more on the guy when you should actually be hedging that bet or not doing anything, not throwing bad money after good. So you're actually given real-time evidence as to how your bet is playing out, and it ain't playing out well, and you're doubling down on it. And the only reason why you're doubling down on it is because you're biased in the first place. Your mind is wicked, especially when it is given a bias. That's why it's easy to brainwash people, because you just give them a bias and sell them on, you speculate enough and it becomes a fact.
Hey, at the Open, my bias was short, and I thought we were going to 26, 27, but, for example, I don't know, some of the prices I sold, they were like 35, 30, whatever. I mean, what if you kept that bias with still, being short from those prices? It's just not working out very well for you, So
a bias, and it becomes like gossip. It becomes very destructive in what you're doing. I'll give you an example. It could take very smart people and make them say things that are not true, and they don't realize it. Let me give you an example. On opinion news shows, which are many of them around the world now, right? Everything's a lot of contributors and people that give their opinion. That's what they're paid to do. Well, if all you do as a anchor woman is listen to these opinions, okay, and that's what they are. Some of them are based on some facts, some are not, speculative, blah, blah, blah. All of a sudden, you listen to enough of it, and it becomes the way it is. So this particular woman was asking a guy who does focus groups about the campaign and about the election. And he said, this guy I think is going to do better in this state. She says, but the other guy has got this establishment lane, though, I thought. And he goes to her. She's a smart woman, and he goes to her. That's stuff that you guys talk about. People and voters, they don't even know what you're saying. They don't even know, and they don't even react to that. That's something you guys have contrived. She was dumbfounded. I don't even think she got the fact that she had heard stuff enough and sold it to herself as everybody believes that. No, everybody that listens to what you listen to every day believes that. And the masses have no idea what the hell you're talking about. And it happens all the time. And that's how powerful it is to listen to a bias that you've already sold to yourself. You can be dead wrong and not know it. And you can be really smart and not realize how your bias is destructive to you, even in keeping you in good trades. Not necessarily getting out of bad trades, George, but keeping you from getting into good trades. Keeping you from being objective. So anyhow, like this market, I got to go back to my chart a second. Hold on. This market got bullish above those 40 halves, went to 43 half, and now is on a 4 PNF sideways chop, holding above the thin spot. Has buy stops above 43 half, but sell stops below 41.75. Short-term stuff, you got to be nervous if you're long if it starts to creep below 41.75. Just short-term stuff. Now, this is just how to get yourself up in your chair. If you wanted to get long, you're a little late because you should have already been long as it cruised through 40.50. So you have to understand that. If you want to get long, you have to know in context that there was an opportunity to get long to anticipate this move 10 minutes ago. Smarter people than you got long, better traders than you. Some days I'm the best trader in a group of a bunch of traders. Sometimes I'm not. But better traders than you got long anticipating it going to 43.5 through 40.50. All right? They're in and probably out. If you're looking to get in here, your risk is below 41.75. Your reward, the champagne, is above 41 or 43.75. Ultimately, then, George, let me look at your chart again. Ultimately, draw a line back through the middle of this consolidation almost. It would take you to 40.75, I think, on your 6 PNF chart on the left. Somewhere in there, ultimately, is when your horns have to be taken off. Not necessarily go from a bull to a bear, but go to neutral if you start getting through that line. That's a line in the sand. You could tie it up and say 41.75 is a line in the sand to start being nervous long. But right now, for all intents and purposes, it should take out the overnight high, which is also yesterday's high. But you see how George was short and got out at 38.5. Where'd you get out when you seen that big imbalance? But 38.5 was also a line in the sand from the previous consolidation. Look at how that came in.
I did off 38.5, and then the balance 39.5. And, you know, I still had hope because I was kind of holding 39.5, and then once I broke it,
it's only going to help you guys to understand what your step one is, to explain what your step one is to yourself or others. You don't have to explain it to others, but you have to explain it. And now you've got the structure of kind of what ours might be. Now, that doesn't mean your step one is just like our step one. That's absolutely the wrong way to look at this. Your step one doesn't have to be just like mine or George's. There'll be some similarities because this is the right way to value price, but not the exact step one. It might not be right, your step one, for all the other 9 guys listening, for example. If there were 10 people listening, the other 9 your step one might not be exactly right for them, but it could be exactly right for you. That's why style is different and why you shouldn't trade exactly like someone else. But you better have the principles, the fundamental principles as part of your step one being the same. You better have helpers insofar as market relationships. You better have the ability to read imbalances and big buyers and sellers that come in and what it does. You better have the sense of knowing where the lines in the sand or the accurate fights are based on stuck positions and not mathematical formulas. And you better anticipate bullish above and bullish above and bearish below. And you better explain how you're going to execute your trade, not come up with the bias of your trade. I would like someone to say, I'm not bullish until this. Like I'm bullish right now doesn't make me long, because I should have already been long through that cruise from that purple line George has still in there. There's no randomness to that happening. You guys have seen it time and time and time and time and time again. The only way you're going to be consistent at catching it is to know when your step one is approaching it, and then also where you're out for a loser when those don't work. You want anything to add, George?
not that I could think of right now.
I'm going to go with Peter next week. He answered in here about contributing, and he's a Chicago guy. Peter, for a brief session next week, we could do this with you. Do you mind showing you don't have to show your charts. You could show mine and tell me what charts to look at. If you want to show a screen of yours, it's really easy to do. I'll walk you through it 5 minutes before. All right, good. So I'll walk you through it 5 minutes before so you know how to, just really simple. Hey, if George could do it, you could do it. Just kidding, George. But it is pretty simple, isn't it, to change the screens?
Yeah, it is. Yep.
It's not that difficult. But everything could be harder than you think till you do it. But what we're trying to do here is crystallize your step one, whatever it is. Crystallize the strategy. Crystallize what's going to work best for the individuals in here. The fundamental principles are explained over and over and over again. And now the specifics of how to execute and how to get out and how to sit up in your seat are being hammered away on. I'm going to end the recording for those watching in the future.